Hello there, everyone. This is Big Economist. Every day, an enormous count of 20,000 vehicles is reclaimed, which equates to an approximate 600,000 vehicles monthly. These cars are immediately placed on the auction block or returned to the dealer. Amidst this, car insurance costs have surged considerably, marking a 20% rise over the past year, and are predicted to further increase in the near future. In 2019, an average car loan installment was about $350, $370 per month. Today, it's $716 per month, a near doubling. Despite this, real income is declining. Additionally, 1 in every 6 auto loans are currently above $1,000 per month. We're observing significant shifts in the auto market, and my forecast is that insurance rates will escalate dramatically, forcing many people off the roads. This is a big deal. If you're considering upgrading your current vehicle, be patient. There might be some fantastic deals on the horizon. Don't forget to hit the like button. YouTube will then share this content, raising awareness about the actual state of the U.S. economy. Consider this. Why are car insurance rates increasing? Over the past year, car insurance rates have spiked by 17%. For instance, in Florida, a state that's slightly more expensive than average, full coverage insurance is, on average, $300 per month. Current insurance rates nearly match an entire car payment from 2019. That's quite astonishing. The Wall Street Journal found Allstate raised car insurance premiums by 40% in Georgia. Nationwide Mutual increased insurance rates by 32% in California. State Farm raised rates by 11% in New York. The cause? Many of these insurance companies have sustained heavy losses in the past few years, implying that premiums will keep growing into 2024. They probably need to increase by 5–10% in the upcoming years. Now, here's what I believe. I think the increase might be double or even triple that. Here's why. As rates continue to rise and affordability worsens, people will begin to cut back on costs. Car insurance is a significant expense. I think many will choose to go without coverage, deciding to deal with any potential damage from an accident when it happens. This will mean insurance companies will cover the cost of accidents involving their insured clients and uninsured drivers. As such incidents increase, insurance companies' losses will grow, and they'll pass these on to consumers through further rate increases. We'll likely see insurance rates shoot up to levels many are unprepared for. On Wednesday, the Bureau of Labor Statistics announced the latest Consumer Price Index for June. Although annual inflation in the U.S. eased to 3%, car insurance rates, a component of the index, jumped a hefty 16.9% year-over-year, surpassing pandemic peaks. Check this out. In Florida, there were 401,533 accidents in 2021, averaging 1,100 accidents daily. This figure has since risen, representing a roughly 15% jump from 2020's average of 933 accidents daily. We're witnessing more accidents than ever. Now, if we examine car insurance costs, they were averaging about $100 a month 3 years ago. Now they've nearly doubled in almost every location in the last 3 to 4 years. It's quite astonishing. Meanwhile, used vehicle prices have dropped for the 3rd consecutive month, with wholesale prices down more than 10% year-over-year. This signals a softening in the auto market. Now, according to Experian, the monthly payment for a brand-new car in 2019 was $554. That's 30% less than today's used car payment of $391. Incredible, isn't it? Currently, the average car payment is $716, with 1 in 6 cars having payments exceeding $1,000 per month. Here's the part I don't understand. The median American income is roughly $31,000 per annum, which translates to $2,800 per month. With the average person likely spending $1,200, $1,500 monthly on car expenses, that's 50% of their total income dedicated solely to their vehicle. Let's break it down. $716 for a car payment, add weekly gas costs of about $50, that's $200 a month, making it $916. Factor in maintenance costs like oil changes, tire replacements, repairs. Let's say that's another $100, $150 a month. We're up to about $1,100. Then add car insurance, which can run $200, $300 a month. Suddenly, you're spending $1,300, $1,500 a month on a car. How is this affordable? As we witness this, we're likely to see a rise in rates and a softening job market, and incomes will likely continue to soften. I predict we'll see a lot of people abandoning their cars and a major shift in wealth. There are now more auto loan delinquencies than there were during the 2008 financial crisis. Think about that. Harley-Davidson's new problem: rising car repossessions. Cox Automotive found a 20.4% increase in the nationwide rate of vehicle repossessions. The bad news is that this is probably only the start of a growing trend. What's even more astonishing is the average car payment and average loan-to-value ratio. Many people owe 125% of their car's value. They see an offer for 0% interest for 6 months or 0 down payment, and they think, "I'll take that deal. I have a stimulus check, low interest rates, I'm earning money in crypto. I'll go buy this Dodge Charger or this Nissan Altima. It's a $40,000 car. I'll pay $10,000 over sticker, making it a $50,000 car. But I found a lender who'll give me a $60,000 loan on a $50,000 car." So why would they give you a $60,000 loan for a $50,000 car? All the extras, taxes, tags, stickers, they're all rolled into the loan. That's what's happening with the 125% loan-to-value situation, which was the norm. Seeing this now indicates a huge problem. Many people are underwater on their cars, with their real wages dropping and living costs increasing. How could this not turn into a major crisis? I don't see any way this could just be absorbed into the economy without any repercussions. About 85% of new cars and 55% of pre-owned vehicles are bought with loans. This reality provokes a significant question. What's the future scenario? Expect insurance costs and fuel prices to keep climbing, especially as we shift towards green energy. This switch in energy sources will likely lead to increases in oil and gas prices, repair costs, and insurance charges. My prediction is an ongoing upward trend in these areas. Our understanding of the U.S. economy, transportation, and real estate is undergoing a vast change. Astute investors are taking notice and positioning themselves for what could be the biggest wealth shift in history. Some may feel comfortable with average monthly car expenses ranging from $1,300 to $1,500, but can most people afford this? It's a fact that 1 out of 6 people have car payments exceeding $1,000 per month. Consider it $12,000 annually for car payments and at least an additional $4,000 for insurance. That's $16,000 each year, excluding fuel and repair costs, totaling around $18,000 to $20,000 per year to maintain a car, which is an absurd expenditure. Imagine if you earn $100,000 per year and are spending 20% of your income on a car, which is a reality for 1 in 6 Americans. It's unsustainable, and auto repossessions are predicted to increase from 20,000 to up to 35,000 a day. Some may argue that such a scenario is unlikely, but let's wait and see. The anticipated shift in the job market will impact consumers' pockets, forcing employers to explore cost-cutting strategies. Likely responses include hiring cheaper labor from abroad or using technologies like ChatGPT to reduce costs. This will likely result in wage decreases. However, smart investors who can piece together these trends stand to benefit from this enormous wealth shift. This upheaval provides opportunities for reevaluating business models and seeing the world in a new light. The principle I advocate for is, money is never lost but transferred from one group to another. Thus, positioning yourself for this wealth transfer is crucial. Regardless of a potential auto market crash or skyrocketing insurance rates, if you're well-positioned, these changes won't concern you because you'll be making profits. Be aware, things will become more expensive, but opportunities will also abound for those who can connect the dots. What's your opinion on this? Please like and leave your comments below.